The American dream? Lately, it's starting to feel less like a dream and more like you're negotiating with a captor. You spend 10 years saving every spare dollar. You battle through bidding wars, outbidding strangers for a slice of stability. Finally, you're handed the keys to your own little corner of the country. But that's when reality shows up, with a bill in hand. The kind of bills they don't advertise on real estate flyers. That $300,000 house you just bought? Surprise! It's quietly draining another $50,000 a year from your wallet. Taxes, insurance, hidden fees, all those lovely extras they forgot to mention. It's not just unfair, it's a trap. So we're hitting the road. We're taking you on a tour through the 10 states where this so-called dream is crumbling the fastest. Stick with me, because I'm going to point out exactly where the biggest financial landmines are buried, so you don't accidentally step on one. This is your no-nonsense survival guide to the modern housing market, where your mortgage isn't the biggest danger anymore. It's everything around it. And don't think you're safe just because you're nowhere near a coast or a wildfire zone. There's a quiet Midwestern state, yes, Midwestern, where your property tax bill can legally double in just 1 year. Or those scenic mountain towns? Some insurance companies have stopped answering the phone altogether. So if you're sick of being blindsided, hit that like button. And if you don't want to get caught by the fine print, make sure to subscribe. All right, bags packed? Let's hit the road. Number 10. Nebraska. You roll down the windows and the breeze smells like earth and cornfields. Welcome to Nebraska. It's flat, it's peaceful, and at first glance it feels like nothing bad could ever happen here. Everything looks tidy. Homes are solid, lawns are freshly mowed, and there's this quiet illusion of affordable, small-town living. But that's just the surface. Beneath all that calm, there's a financial machine quietly grinding away at homeowners. The real tornado in Nebraska doesn't come from the sky. It shows up in your mailbox in the form of a brutal property tax bill. According to a 2025 study by WalletHub, Nebraska ranks among the top 10 states with the highest effective property tax rates in the entire country. To put that in perspective, rates here can be twice as high as what you'd pay in states like Utah or West Virginia. That modest $300,000 house you thought was a steal? It could be saddling you with a $5,000 annual tax tab, over $400 a month just to exist on your own land. So why is it so steep? The short answer: schools. Nebraska leans heavily on property taxes to fund its education system. And those education costs? They've been climbing for decades with no signs of slowing down. But the financial strain doesn't stop there. Next up, insurance. Living in Tornado Alley used to be a known risk, manageable, predictable. But in recent years, a wave of severe hailstorms and twisters has pushed insurance premiums through the roof. Industry data shows some Nebraska homeowners saw their rates jump 20 to 30% just in the past year. It's a slow-motion crisis. No dramatic headlines, no sudden stampede out of the state. Just a constant suffocating squeeze from rising bills no one can negotiate. People move here looking for peace, a break from the chaos of big cities or coastal disasters. Instead, they find themselves trading hurricanes for property tax storms that hit just as hard and never let up. So if you're in the Midwest, I want to hear from you. Are you feeling that slow financial bleed from property taxes and insurance? Drop your state and how much you're paying in the comments. Number 9. Oregon. You head west, leaving the flatlands in your rearview mirror, and drive straight into a living postcard. Towering trees rise on both sides of the road, thick enough to sip the sunlight right out of the sky. The air smells like pine needles and rain-soaked soil. It's the kind of place where you half expect a deer in a flannel shirt to hand you a mortgage brochure. This is the Oregon dream, filtered through 1,000 Instagram reels. It promises serenity, a back-to-nature lifestyle, and a progressive escape from the grind of city life. You finally stumble upon a little cabin nestled in the woods and think, this is it. This is the life. But then reality checks in. Hard. You try to get the place insured. And suddenly no one picks up the phone. Here's the thing. Oregon is quietly unraveling into an insurance nightmare. The state's own division of financial regulation has been sounding the alarm. This isn't hype, it's happening. After years of destructive wildfires tearing through the region, insurance companies have become gun-shy. They've rolled out hyper-aggressive risk models that instantly flag forest-adjacent homes as too risky to cover. Your peaceful woodland retreat? It might already be on a list, labeled uninsurable before you even move in. In high-risk areas like Ashland or the Cascade foothills, homeowners have watched their premiums double, sometimes even triple. And for thousands more, the worst envelope you can get is showing up, the non-renewal notice. No warning, no appeal. Just dropped. You're left to figure it out alone. And even if you manage to dodge wildfire risk, good luck dodging Oregon's tax collector. This state isn't just burning forests, it's burning through your income. Oregon has one of the steepest income tax rates in the US, peaking at a staggering 9.9%. So for every $100,000 you earn, the state grabs nearly $10,000 before the IRS even touches it. That's California-level taxation, without the six-figure Silicon Valley paychecks to soften the blow. They call it the paradise tax. You're not just paying for the view, you're trading financial security for scenery. On one side, there's literal fire threatening your home. On the other, there's financial fire draining your savings. So let me ask you, at what point does the price of beauty become too high? How much would you pay to live somewhere this breathtaking before you finally say, enough? Number 8. Illinois. As you cross into Illinois, the horizon opens wide. Flatland, stretching into towns stitched together by farmland. The houses are sturdy, mostly brick, built with that no-nonsense Midwestern sense of permanence. It feels like a place where people settle down, plant roots, and build a life. But lately, more people are packing up than settling in, not because of wildfires, not because of hurricanes. They're fleeing something far more relentless: taxes. Illinois isn't just bad when it comes to property taxes. It's in a league of its own. According to a 2025 report from the Tax Foundation, it's been neck and neck with New Jersey for the top spot on America's most punishing property tax leaderboard. The average effective rate here? A brutal 2.3%. So that $300,000 home you were already struggling to justify in Nebraska? In Illinois, it'll cost you over $7,000 a year in property taxes, minimum. And if you're in the Chicago suburbs, buckle up. We're talking $10,000, $15,000, even $20,000 a year for an ordinary family home. It doesn't feel like a tax bill anymore. It feels like a second mortgage you never actually signed up for. And people are responding with their feet. Moving data from sources like United Van Lines and even recent U.S. Census numbers show that Illinois has become a nationwide leader in one bleak category: people leaving. More residents have been moving out than moving in, for years. Why? Because the state's finances are caught in a vicious cycle. Years of budget problems have forced lawmakers to keep taxes sky high. But high taxes push families to leave, which shrinks the tax base. So to cover the gap, the state has to crank taxes up even more. It's not just a problem, it's a death spiral. When you buy a house in Illinois, you're not just buying a home. You're buying into a share of the state's massive unpaid bills. The real estate might be within reach, but the cost of staying here? That's what breaks people. So, for those of you living in Illinois, or those who recently left, does this sound familiar? Are sky-high taxes the real reason so many moving trucks are rolling toward the border? Drop your story in the comments. Number 7. New Jersey. You merge onto the turnpike and suddenly, everything feels tighter. The lanes narrow, the neighborhoods crowd in, and the space between homes starts to vanish. You're caught between two titans, New York to the north, Philadelphia to the south, each pulling on this state like a financial and cultural tug of war. This is peak location, location, location. The jobs are nearby. The arts and culture are world-class. And the shore? Just a drive away. You find a charming colonial in a picturesque town with top-rated schools and think, we did it. We made it. And technically, you did. You made it to the very top of the property tax charts. We're not talking exaggeration. We're talking cold, hard numbers. Year after year, the Tax Foundation confirms it. New Jersey homeowners pay the highest property taxes in the entire country. According to 2025 data, the average annual bill here is pushing $10,000. That's not for a luxury estate. That's just average. Own a $400,000 home? You could be shelling out over $800 a month, just in property taxes. That's the same as a car payment or a student loan. It's like a second mortgage, one that never ends, only increases. And the justification? People say it's for the schools, the access to the coast, the convenience of the commute. But here's where the real sting kicks in. That coastline you're paying a premium for? It's creeping closer, literally. Recent analysis from Climate Central paints a concerning picture. Thanks to rising sea levels and stronger storms, large portions of the Jersey Shore are now at serious risk of chronic flooding. Places that used to flood once every decade, now they're seeing streets underwater multiple times a year. And when that happens, guess what else rises? Flood insurance premiums, if you can even find coverage. FEMA's revamped rating system has sent prices skyrocketing in many coastal counties. So now, not only are you paying the highest taxes in America, you're also shelling out thousands more each year to insure a home that might one day be declared waterfront property after just one bad storm. This isn't just a tough break, it's a financial mousetrap. So here's the real question. If your property tax bill is already at $10,000 a year, how high would your flood insurance have to climb before you finally say, that's it, I'm out? $3,000 more? $5,000? At what point does the dream of New Jersey living turn into a delusion? Number 6. Arizona. Head southwest, and the scenery doesn't just change, it transforms. The soft greens of the Midwest fade into a sweeping desert palette. Towering saguaro cacti, rust-colored cliffs, and skies so intensely blue they almost look fake. You cruise into Phoenix, passing street after street of gleaming stucco homes. Gravel-perfect yards, sparkling backyard pools. It's clean, it's modern, and compared to California, it feels like a steal. This is the Arizona pitch. The good life, minus the price tag. A forever vacation baked in sunshine. But then, you twist the faucet. And somewhere in the back of your mind, the question creeps in. How long can this last? There's a quiet truth everyone in Arizona knows, but rarely wants to say out loud. Water. The entire state is built on a high-stakes engineering miracle, one that piped water from the Colorado River to make the desert bloom with suburbs. But according to 2025 projections from the U.S. Bureau of Reclamation, that miracle is reaching its limits. After more than 20 years of drought, the river that sustains Arizona is running dangerously low. And this isn't theoretical anymore. In some of the fastest-growing areas, officials have already hit pause on new housing developments because builders can't prove there's enough water to last a century. Think about that. You literally can't build a home in certain parts of Arizona because no one can promise the water will be there for your kids. And even if you have a home, there's another growing threat: the heat. This isn't just a hot day heat. This is the kind of brutal, unrelenting temperature spike that breaks records and infrastructure. National Weather Service data shows Phoenix and surrounding cities are logging dozens of days each year above 110 degrees Fahrenheit. And living through that means running your AC full blast for months. For many, summer power bills are now soaring past $400, $500, sometimes more. It's the hidden sunshine tax, a price you pay just to stay cool enough not to end up in the ER. Buying a home here means signing up for a lifestyle that's fundamentally in conflict with the environment it sits on. It's a wager, a belief that human innovation will outpace what nature is clearly trying to correct. So let me ask you, is it wise to plant roots in a place that's actively drying up and heating up? Or is the promise of affordability today still worth betting your future on? Number 5. Colorado. You leave the desert in your rearview mirror and start the long ascent. The air grows cooler, thinner, almost electric, and suddenly the Rockies erupt across the horizon like a painting come to life. Towns like Boulder and Golden welcome you with their picture-perfect charm, where hiking trails start at your doorstep, ski passes are practically a lifestyle, and craft breweries outnumber chain restaurants. This is the Colorado dream. A life of wellness, adventure, and views so breathtaking they barely seem real. You splurge on a home with a mountain backdrop, paying extra for that slice of heaven, and for a moment, it feels worth every penny. Then the bills start rolling in. First hit, your insurance agent. After disasters like the Marshall Fire, which leveled over 1,000 homes in just a single afternoon, the state's insurance market has gone into full-blown panic mode. The Colorado Division of Insurance confirms what homeowners already know. Premiums in scenic but wildfire-prone areas have exploded. In some mountain towns and foothill neighborhoods, insurance rates have surged by 50%, 100%, even 200%. And for thousands of residents, it's worse than sticker shock. They've been dropped entirely. No insurer will touch their property. And without insurance? Forget getting a mortgage. That million-dollar view becomes a financial anchor. Beautiful, but impossible to sell, refinance, or protect. Second hit, the taxman. Following the repeal of a decades-old law that had capped property tax increases, reassessments across the state have been, in a word, brutal. In 2025, the Colorado Sun reported that many homeowners saw their property valuations leap by 30% to 50%. Not because they renovated, not because their income increased, but because the market said, your view is worth more now. And with that paper value came a very real, very painful tax bill. So now you're paying premium prices for a home in a wildfire zone. You're paying extra for the risk of losing it. And then you're taxed even harder because that risk is perched on a scenic hillside. This is the fine print of paradise. And here's the kicker. We're only halfway through this road trip. If you think this financial squeeze is brutal, wait until we hit the states where the disaster already happened and swallowed entire communities whole. Number 4. Texas. Cross the state line into Texas and everything suddenly feels bigger. The sky stretches wider. The highways expand. And ambition? It's in the air. You cruise through the sprawling suburbs of Dallas or Houston, and it's construction as far as the eye can see. Brand new homes, gated communities, shiny new schools. This is the Texas promise: unlimited growth, fewer rules, and more house for less money. And for a moment, it feels real. You land a 4-bedroom home for the cost of a studio in Denver. You pay 0 in state income tax. You tell yourself, I figured it out. This is how you win the housing game. But then the bills show up. And you realize, the system wasn't built for you to win. It was built to win off you. First punch? Property taxes. Texas doesn't collect income tax, so it leans hard on property taxes to fund schools and public services. And if you live in a good school district, that's going to cost you. Sources like the Tax Foundation rank Texas consistently in the top 5 states for highest property tax burdens. The average effective rate? Nearly double the national average. So that $400,000 dream home. You might be looking at an annual tax bill of $8,000, $9,000, even $10,000. It's an unrelenting financial weight that doesn't care if you've retired or hit hard times. Many longtime residents on fixed incomes are being taxed out of the very homes they raised families in. Second punch? The grid. After the deadly 2021 winter storm caused the state's electric grid to collapse, Texans learned something chilling. ERCOT, the state's independent power grid, is a high-stakes gamble. Every summer, as triple-digit heat drags on for weeks, the grid flirts with disaster. Power companies beg people to raise their thermostats just to avoid blackouts. And what's the reward for all that conservation? Sky-high electric bills, some of the most expensive in the country. And then comes the weather. Down on the Gulf Coast, hurricanes are rewriting the insurance rulebook. Every major storm sends premiums spiking and deductibles rising. Worse yet, many policies come with percentage-based deductibles. That means if your $400,000 home gets damaged, you could be on the hook for the first $20,000 out of pocket, just to start repairs. So yes, you're not paying income tax. But ask yourself, are the brutal property taxes, unreliable power, and hurricane-level insurance costs just the hidden price tags no one tells you about? Or is no income tax the most successful marketing scam in the country? Drop your thoughts in the comments, because for many Texans, the real cost of living is everything else. Number 3. Louisiana. Drive east out of Texas and the air begins to change. It thickens, slow, heavy, rich with humidity and history. The flat plains give way to bayous and wetlands, and suddenly, you're surrounded by something deeper than landscape. Culture. The music seeps from open doors. The food smells like it has stories. The architecture, charm wrapped in weathered wood and wrought iron. You feel it. The rhythm of New Orleans, the soul of the South, the promise of a life that tastes, sounds, and feels alive. Then you see it. A beautiful old shotgun house, right in town. Asking price? $180,000. You do a double take. That's less than half of what you sold your place for in Austin. You think, wait, I could actually live here. Really live. Then you make one phone call, and just like that, the dream evaporates. Welcome to Louisiana, home to the most broken, battered home insurance market in the entire country. After getting slammed by one catastrophic hurricane after another, Laura, Delta, Zeta, Ida, the private insurance companies didn't just raise rates, they left. According to the Louisiana Department of Insurance, more than 20 insurers have either pulled out or gone bankrupt in the last few years. And the ones still standing? They're charging astronomical premiums. A 2025 market report shows the average homeowner in Louisiana is now paying over $6,000 a year for insurance. Along the coast, that number explodes. $10,000 or more isn't unusual. Let's break that down. Over $800 a month to insure a $180,000 house. You're not paying for protection. You're taking on a second mortgage that doesn't even buy you ownership, just a chance not to be ruined. And when private insurers say no, your fallback is Louisiana Citizens, the state's insurer of last resort. But here's the catch. By law, their rates have to be even higher than the private market to avoid competing. It's not just a burden. It's a state-mandated penalty for trying to live in your own community. You're not buying a house in Louisiana. You're buying into a financial casino where the odds are rigged, the stakes are high, and every hurricane season is another spin of the wheel. The homes are cheap because protecting them has become wildly, dangerously unaffordable. So here's the thought experiment. If someone handed you a free house in Louisiana, no strings attached, but you had to cover that $10,000 a year insurance bill in cold hard cash, would you stay, or would you just roll up the windows and keep driving? Number 2. California. You head north along the Pacific Coast Highway, where the road snakes along cliffs that plunge into crashing surf below. The air glows with that soft, golden hour light that never seems to fade. It feels like anything is possible here, like you've reached the edge of the world and the start of a dream. This is California. Not just a state, an idea. The cultural epicenter of the world. The land of startups, stardom, surfboards, and second chances. You find a house tucked into the hills above Malibu or clinging to the canyons outside LA, and for a moment, you feel it. This is the pinnacle. You've made it. And then comes the gut punch. You can't get it insured. This isn't some looming threat. It's happening right now. Major insurance providers, household names like State Farm and Allstate, have either slammed the brakes on new policies or pulled out entirely from certain regions. The result? Vast stretches of California are turning into what insiders are now calling insurance deserts. The California Department of Insurance confirms it. Hundreds of thousands of non-renewal letters have gone out in just the past 2 years. People aren't being warned, they're being abandoned. Why? Because wildfires in California have gone from seasonal worry to apocalyptic event. Insuring entire zip codes has become a financial black hole for providers. So if you want coverage, there's only one place left to go. The FAIR Plan, California's state-mandated insurer of last resort. But let's be clear, this is not premium protection. It's a stripped-down, no-frills plan that often costs double or triple what you'd pay elsewhere. And what do you get for that price? A fraction of the coverage. It might not cover liability. It probably won't cover water damage, like the kind that now regularly floods homes thanks to atmospheric rivers slamming into the state. So, in reality, you'll need another policy just to protect yourself from the other disasters California throws your way. And all of this, every inflated premium, every ghost policy, every rejected application, is for a house that already costs more than $800,000 on average, according to the California Association of Realtors. Let that settle in. You're not just buying a home. You're buying a liability the financial system has already written off, $1 million structure that no one wants to insure. So here's the question. when the very systems designed to protect your property refuse to touch it? Is that still an asset? Or just a beautiful liability with a killer view? Number 1. Florida. And here we are, the end of the road. Not just the final stop on this cross-country housing nightmare, but the epicenter of it. Welcome to Florida, the place where everything we've seen, skyrocketing insurance, climate catastrophe, and affordability collapse, crashes together into one massive, perfect storm. This isn't just the worst state on the list, it's the red flashing warning light for the entire American housing market. The place where the dream finally, and officially, dies. According to the Insurance Information Institute's 2025 data, the average homeowner in Florida is now paying more than $6,000 a year for insurance. That's $500 a month. Not for your mortgage, not for your taxes. That's just what you pay a company hoping they'll still be around when the next hurricane floods your street like a bathtub. This isn't just expensive, it's a market failure in real time. Private insurers have been pulling out left and right, driven out by back-to-back disasters and unsustainable risk. Dozens are already gone. And in their place? The state-run safety net known as Citizens. It was never meant to handle this volume. But now? It's the only option for millions. Citizens has ballooned into a financial time bomb. Fragile, over-leveraged, and barely staying afloat. And if a Category 5 storm hits and empties its reserves, the entire state could be slapped with a hurricane tax to bail it out. You heard that right. You're paying the highest premiums in the country, just to be first in line for a potential statewide bailout. It's not just unsustainable, it's mathematically insane. The house isn't an asset anymore. It's a bet you make against nature and the collapsing systems trying to control it. It's the bait in a trap, spring-loaded with climate risk and corporate greed. So, is this still paradise? Or has it become America's most beautiful, sun-drenched financial ambush? Let me know in the comments. And that's it. We've reached the end of the journey. 10 states. 10 cautionary tales. We drove through regions being drained by taxes, scorched by uninsurable wildfires, and flooded by policy failures that have already begun to unravel. But here's the real takeaway. It's not just about avoiding hurricanes or wildfires. It's about understanding the fine print on your tax bill, on your insurance policy, and in the infrastructure holding your neighborhood together. Because that's where the real disaster often hides. Did we miss a state you think is quietly becoming unlivable? Drop your experience in the comments. We want to hear your warning. And if you want to avoid getting trapped in the next real estate nightmare, hit that subscribe button. You're going to want to be here for the next map.